All right, so let's look at some live charts here. I want to introduce some setups, some entry signals, and so this is more that's going to be shown here. But working off of what we've already seen, gone over. So pound dollar, I took one trade long last week. Now let's look at what was going on before that. Now here's where I took the trade. That little box shows just the general area. This was Tuesday. So just looking back, now we are in a markup phase, right, as we talked about, not only because we're making higher highs and higher lows, and we appear to be in an uptrend, but we want to make sure, always as part of this process, that volume is agreeing or confirming that we're still in a healthy uptrend, that we expect it to continue, and that we are looking to buy. So let's look at now we're on our 1 hour chart, and I didn't do larger time frame analysis here to show you. I just want to hone in on this particular couple of things. So coming into this day, let's look at our background. Okay, and we're on a 1 hour chart, and that's where I'm looking at volume and recent high volume points to tell me where smart money is positioned from. And if we're in an uptrend, we can see if they're continuing to buy or if they're starting to sell at high prices, perhaps. So here's looking back. Now, the day before, Monday, very low volume. This is typical sometimes on Monday where there's just not much activity. You can see on this day, it's a very small range. So if we're looking at our recent high volume points, there's really nothing here. So let's go to Friday. Friday, this stands out early as a higher volume. And you can see that it's a sign of strength. Why? Because as price came down, and in this case, and as it very often does, into the fib zone, as price came down, what happened? We know this because we were starting from this point, right? It came down. It was a large red candle. The activity became high, and it closed back, closed back at the open, which is a very strong sign, obviously, that buyers came in. Otherwise, price would not have been able to do that, right? It also happens to be in the fib zone, where we know that this kind of stuff tends to occur. It's always a good marker. So we have that. And now this is just looking at the background, but things that I can point out. And you'll start to see the repetition in the patterns and using the tools. So here's a little support area, and you can see it's also a fake breakout. So we have that pattern as well. Again, very common pattern. I mean, the fake breakouts are all over the place. So here's a resistance and a fake breakout. So they are all over the place. Now that high price there does not have a lot of volume. So in this, it didn't show that there was a lot of sell activity into that up move, but into this down move and into these lower prices and slightly below that support and the low of the day, right, because the day starts here. So the low of this day did bring a lot of activity and buyers. So we can say throughout this, as we look at our background, what is the high volume saying? So again, here, now you might say, well, this is high volume on an up move, and isn't that a sign of weakness and selling coming in? And perhaps there was selling, and here you have to say there was some selling. But we also are looking at, again, the effort versus result. The result of all this activity was higher prices. Did those higher prices continue to see selling into it? No. And what we have to, as far as high volume, but what we have to consider, and this is very important as you are looking back at your charts and doing your analysis, is that you're considering the time of day, because as we can see, this time, throughout the day, there's pretty much a cycle where we expect higher volumes, we expect lower volumes. We're not going to see this ultra high volume stuff, during these times. 2, 3 GMT is like the worst, the lowest volume. So you may have a little increase at Asia Open. You may have a big increase. So you have to look at the timing, and also we have to consider that this is Friday, because these two lines mark the weekend here. So we have Friday, where there tends to be a little more profit taking. So if we've moved up, and particularly off strength in the background, here again you see high volume off low prices. Again, down moves that get rejected on high volume and continue up as a result, effort versus result. So we have all the strength in the background, and it looks like as we got into later on Friday, 13, 14 GMT, the markets have started to wind down. After that, well, pretty much by 16 GMT, you're pretty regularly losing your activity. Markets are closing for the majority of the world. So profit taking often goes on Friday. So there was some selling here that we could say, but we also have to clear rules here. The result was higher prices that didn't continue to show selling. And those higher prices, again, we don't see any climactic volume, any reason to start selling yet, because, again, we're not seeing. See, if this rejected here had a bearish reaction, and number one, so we would have effort versus result. And number two, to make sure I introduce this principle, is sustained versus temporary. So here we saw a temporary sign of weakness, but what else happened at those prices? It was only temporary, because over time we did not see sustained selling at these prices. And that's typically what you'll see if you're in a real distribution phase and a reversal sort of environment. We'd expect it to actually come down at the higher prices. Now, that is something that I've discovered through my experience in applying this stuff. It's not something that traditionally you're going to learn in VSA. And, I can point out more examples of that, the differences, but, it's mostly the same what I'm doing. And, of course, I'm, using some other tools and sort of doing my own version of it. But this is something that's slightly different where, as we'll get into, like looking at a no demand, I wouldn't want to look for no demand up here. That's a low volume signal. I'd like to see if selling is occurring into an up move that is sustaining over a period of time. Otherwise, it's going to tend to continue. So sustained versus temporary. We'll see more of that. So I'm confident with this background that we're still bullish. We hear it's Monday, not much activity. We get into Tuesday, and again, which is really good to see when you're in an uptrend, is higher prices not attracting climactic high volume. Slight increases are fine. This is basically medium compared to, this is middle of the day, very active time of day, 12 GMT, highly active time of day, and we're not seeing much volume there. So we're not seeing profit-taking supply, or AKA selling, coming in at the higher price. This is the highest price we've seen in the week so far, right? Let's keep track of our prices and our trend. Moving into higher ground, higher prices may attract sellers. Do we see a lot of activity there? No. So as I'm coming on to trade this time of day, around New York Open is my schedule now, I'm seeing this uptrend, and I'm seeing that it's not attracting a lot of sellers. Now, what I like to see as one of my most common signals, and something I want to start out by pointing out, is when you're in the uptrend, it's a healthy uptrend, meaning it's not bringing a lot of selling. I want to look for the retracements, even a small one like this, because we'll get into the smaller time frames, and look to buy when smart money is buying. As we went over, it's called reaccumulation. So we're in an uptrend. I'm not simply looking to just jump in, of course. For me, ideally, and there is a no supply signal, no supply, no demand. We'll get into that, which is a low volume signal. But for the most part, and the most common and a good way to introduce this stuff, is the reaccumulation, meaning you're in an uptrend, and when price pulls back down, retraces, we want to see stopping volume. We want to see strength coming in at those lower prices, as we know, attracting buyers. So I'm entering. I'm looking at that stuff to consider entering. Follow it up to my entry point, starting with the reaccumulation and the buying during an uptrend, because I know that I'm joining the trend when smart money is also either joining the trend or adding to their position in the trend. So I really want to try to be in lockstep with them as much as possible. If I'm not in long through here, but I see them adding to long positions on a retracement, I'm going to join them, doing that. And we'll lead up to, looking at the entries and all that. So February 11th, let's look. Now that we've seen our environment, again, we didn't see the larger time frame support resistance. I'm skipping that for now. But let's look in here, because I do like to use the combination of the 1 hour chart and the 5 minute when we really get into the detail and the volume, right? So let's look at that. February 11th, 5 minute chart. And that's not marking anything in particular, just to mark the spot where I took the trade. Okay, so let's look at what's happening here. Now, a good thing about the 5 minute chart is now that we've seen our 1 hour overview, we know we're in a markup phase, hasn't seen a lot of selling. Let's look at our 5 minute chart. And, the thing with time frames is people think, from one time frame to another, they seem to talk like it's completely different stuff. Well, this time frame says this, but that time frame says that. So now we have conflicting signals. Well, you have to remember that it's different versions of the same thing. It's 5 minute is just more detailed. The 1 hour is less detailed, but it's cycles that matter. And as you go higher, you have less and less detail. You have more just general information. So if I give you information that's general, and you'll say, well, tell me details. You're really investigating that same thing. You just want to see more evidence, more details. So using the tools in the same way on a 5-minute chart, same exact thing. So we can look at the 5-minute chart and see, okay, we do see, for example, some selling that came in, right? As this uptrend was continuing through this day, and this is where we saw it go into new high ground here for the week. This was Tuesday, and we saw a bit of weakness. And you see that weakness that came in, by definition, was the higher volume. That was the highest volume of the day on the 5-minute chart. And we had a bearish reaction, confirming the weakness, and we also see that it acted as a resistance level starting from that point. So no coincidence, because it had attracted sellers. And again, here you see a little more volume, slightly higher price. So we see generally, you could say, some profit taking or some supply coming in. It works together, weakness, selling. So now, if we're looking to go with our phase, is this something that's going to tell us that we need to start selling? Is this going to tell us we can't buy anymore? Not necessarily. It does mean for the moment that there's more selling than buying, and we would not look to enter. But we need, again, something like reaccumulation, and we want to follow with smart money, and a stronger signal of strength than that weakness to suggest it's going to continue. Ideally, this wouldn't even be here. If we're talking about probabilities, tracking smart money, that we're in this uptrend, we're moving up, and that so far the highest prices that we've seen coming into this day, is here, have not shown increases in volume, have not shown weakness. That would always be ideal. So as we go through and I give you this information, you can sort of judge how aggressive you want to be, how good a setup needs to look. And I'll give examples of trades that I've taken so you can get an idea. So, talking about probabilities here. So this takes away a bit of probability. We have to be honest about that. It's a bit of selling. But it doesn't tell us we can't continue to do our thing. This is a 5-minute interval of selling as compared to days worth or hours worth of buying and signs of strength in the background and an uptrend. We also do not see, something to point out here, we do not see sustained selling at this high price, right? Initially selling, initially here a little less activity, but it's there. So those are those two candles going to new high ground at the time. And then what happens here? And what happens all through this area? Are we seeing sustained sell activity? So this is what the principle that I've discovered, I guess you could say, is the sustained versus temporary. So is that selling sustained? Is it consistent over time at the price area? No, it is not, right? Where are those signs of weakness throughout this area? So something like that can also give you the confidence to consider still buying, right? If I saw sustained selling, high volume rejection consistently here, I would be much less likely to consider a long entry. So again, still introducing the concepts and the tools to you and the way to read the chart here. And we'll get into, again, the particular setups and how aggressive. But you need to understand this first, obviously, right? So let's look at what happened here now, okay? So after this, okay, let's see what happened. We have a bit of weakness, but we're overall in a nice, healthy uptrend. We're not seeing sustained selling. Maybe if we can see smart money stepping in and buying in a large amount, then we have our trade, right? So that's what occurred here. Now, price initially moves down, okay? That's initially selling. So for whatever reason, and that may have been on news, looking at the time of day. And initially there was selling. But what was the reaction to those lower prices? Obviously, signs of strength, right? Lower prices came in. The volume became extremely high, making this look small, right? That was the highest volume of the day at this point. Now this becomes even higher volume, showing our principle of lower prices attracting buyers. Now it happened at the 50 EMA, which you can see is acting as support. As I pointed out, support resistance. I think also on the 1 hour, we're seeing plenty of evidence of the support of the 50 EMA. Again, this is just this past week. Let's get back there. So we come down to the 50 EMA, which is a good checkpoint. We could also see that we're basically now, show our fib. This is the low of the day to the high of the day as it retraces. So it just touches that 50 fib, right? So again, we see how useful this is as that checkpoint. Our buyer is going to come in the fib zone. Huge, right? So at this point, and also at closing back, you see the rejection was so extreme there too, closing back at the open. So obviously, again, big red candle at one point, buyer stepped in and closed it back up. Now, again, think, who trades like that, right? Do you trade like that? Someone who doesn't know VSA, do they trade like that? That they would buy, and this isn't, a small percentage of the market. This would have to be a large percentage of the market if it was just the average trader out there that stepped in, and as this was tanking, big red candle, that so many average size traders are going to buy and push it back up. That's typically, no one has the nerve to do that. And again, that's how smart money works, right? So that was an opportunity for them to buy in very large amounts, very, very large amounts. So I would probably safely say that at this point in the day, within this 5-minute interval, if we're comparing 5-minute intervals, that we had the most buy activity of the day within at least these two here. Now, again, this is a down candle, but the activity was extremely high. Now, what does that tell us? That price was bouncing around a lot. This is tick activity we're looking at. So if it was sitting there, we'd have low volume, like it was sitting here, not attracting much selling at the high price. But as it came down, consider this a trap move, consider it maybe a reaction to news, which is very typical, and we'll get into that. News can give this sort of fake move opportunity. And we look at the reaction. But again, very active here. So as price came down, down ticks, up ticks, down ticks, up ticks. What do we know about that? That's down moves attracting buyers, down moves attracting buyers. Obviously very extreme there. Okay, so as we move on, now this gives me the confidence to say they're buying in large amounts on this uptrend now. They're reaccumulating. So going forward, let's look now on the 5-minute. Okay, now as you're trading, you don't have to watch the 5-minute constantly. You can look at the 1-hour chart, you can look at your overview, your phase, and say, okay, is there an opportunity coming up? Right? If there is, then you can go to your 5-minute chart and do this type of analysis we're going to do here. So as we defined, the first level of resistance after strength we call the automatic rally, right? So we have our strength, high volume at the lower prices, getting a little bounce, and a resistance, right? In this case, it was very early. Very often you'll get sort of, it'll happen a little bit later. But this was, within 10 minutes, 15 minutes after, and you're getting your bounce, very quick bounce in this case. And then as it came down, we can say obviously there's a level of resistance that's formed here after the strength. So we have that little pattern. So we have our automatic rally marked going forward. Now at this point, we can start to look for entries going from aggressive to more conservative. As we're in this area, we can consider buying off a no supply signal. Okay, and we'll see plenty of examples of that. It's very common, the most common way to get in. Now the no supply signal, by definition, and this is the one I ended up seeing in real time here and signaling the entry, the lower volume test of the AR. Now it doesn't have to happen at the AR, but this is the one that occurred here. It could happen in here. And we'll go through all the entries. So we're talking about no supply and the definition of a no supply signal to go long. So volume lower than the previous two candles. Maybe I should zoom in here. So we see volume lower than the previous two. This is the technical definition here, but no supply. And it has to be a down candle. Now typically you don't want a large down candle. Something like this, and you can see it's lower than the previous two. What we're talking about is a lack of selling, a test for sellers, okay? And this is pretty much the ideal look that you want to it. It's a lack of activity to the sell side. And as we test for sellers, and particularly as we know the automatic rally is a level to test for sellers, we'll see more of that, that we want to see, activity basically start to drop in the market as they test for sellers, meaning the buyers pause their activity. So again, volume lower than previous two on a down candle. Technically, again, the definition, you want it to close off the low. So you want a little pin on there. Okay. Now, the reason why I'm stressing its technical definition is if you're breaking the rules, at least you're aware of it. For example, if it closed on the low, but it's still a small candle, but it didn't close off the low, you could still, all things considered, if there's 4 other things telling you to take the trade too. You still may want to take, again, it's information, you decide. So, and I'll give examples of my entries. So, technical definition, you want the pin and volume lower than previous 2. Now, as far as how you actually enter this trade, there's a couple of variations. Now, the traditional entry off of a no supply is as price breaks the high of the no supply candle, it confirms and you have your entry. So if the high of this candle is 55, price moves to 56, 55 and a half, whatever your requirement is, and moving above the high there, and you can actually set an order for that to have you enter the market as soon as price moves up there. You can also just, of course, enter manually. Now, that's a very common way. I don't do that. I give it some time here, whether it's a few minutes or ideally waiting for this candle to close, waiting for it to close above the high of that candle. Because, one way to make the point, you could say higher prices attract sellers. So if we're moving up off of a no supply, moving up, I'd like to see what happens. I'd like to see if these higher prices are sustained as far as, not getting rejected, if it's able to hold up there. Ideally, if it's able to close bullish, on, without a large pin, because, again, you never know what can happen. As price moves up, maybe at this point, because there was some selling before, whatever it may be, higher prices, that it would get squashed down on a high volume and close back down. And now you find yourself long just as we saw sell activity come in at higher prices. So that's not ideal, right? So not only do I like the no supply, I like to see the confirmation of price sitting above there without getting rejected. So closing at or near the high, above here, and giving it that time. Now, if price just starts to run off very aggressively, I may not wait for the close. If it's really just sitting there, starting to inch up, and there's only 30 seconds left on the candle or whatever, then I may enter, before the close. But you get the idea. It's a little last piece of information to help your probability. The last thing you want is for price to come up, get you in immediately, get squashed down, and now you're in this trade you'd rather not be in, right? Now, technically, that would also cancel out the no supply. So just as closing above confirms it, or moving above the high confirms it, closing below the low of this candle, closing below the low of your no supply candle will cancel it out. Why? Because we're testing for sellers, and we're seeing a lack of sellers, and then buyers continue. But if there's a lack of sellers and it continues down, well, there's still more selling than buying, right? We're waiting for those buyers to pounce off the lack of selling. So we want that, that bounce to start to occur. If we close lower, below this low, then to me that cancels it out. So it's no longer a valid no supply. Now this could be another no supply, even lower volume, and little candle closing off the low and then move up, and that would be fine. We'd have generally a low volume test with over a couple of candles. It would probably be a no supply in the 15-minute chart, including those few candles, right? So we can generally get multiple no supplies. But if it closed below and volume was not lower than previous 2, we're resetting. It cancels it out. There's no potential no supply. Now, we're talking about strength, talking about no supply. Now, remember, all this stuff applies in reverse, and I'll make sure to give examples of a no demand, the opposite of a no supply. So just to be aware, it all works the same in reverse. Lower prices attracting buyers, higher prices attracting sellers, and all that. Same thing. Okay, particularly in Forex, it's the value of one currency versus another. There's no absolute value. These values are always shifting based on supply and demand. And, you could flip it around, dollar versus the pound, and, the exchange rate at 80 cents or whatever, and just do the opposite. So everything here works, in the inverse, right? Okay. So now to point out this entry, okay. Now, did I enter sooner? I may have entered a little more aggressively here, but this is your typical entry off of a no supply with strength in the background during a reaccumulation showing up at fib. Okay, so this is very textbook here. Now I finished out the day with a little move up, kind of sat there, no activity. Here's the off-hour stuff talking about, right? There's not much going on, and look what happens when we get into the next session. Another little trap move, but this trend now went on for days and days and days. So it went on until the end of the week from that Tuesday to Friday. So it's not just because of this setup. It's because we were in a markup phase. There had been buying in the past, and until we saw a proper profit taking and supply coming in, that trend's going to tend to continue. So that's what happened. Okay. So there you see an example of a setup using the tools, the fib. Let's see if there's any other confluences. Yeah, there was a previous resistance turn support. This stuff all helps the probability here. See this resistance kind of pop through, fake breakout pattern, right? Coming back to support off of that. But generally in here we're dealing with a resistance in this area. You could even draw a box right through here. So it's a resistance turn support. That's the area that it broke, came back to test, saw buyers, right? It continued. So we have break, test, continuation pattern, fib retracement, and the previous resistance turn support. The 50 EMA on the 5-minute was also there. So a lot of confluence, right? So again, this is just the last trade I took on the pound. It's not always this clean. There are days when there's no trade and all that. Let me point this out. This just popped out at me, so I can show this one more time here. The sustained versus temporary, okay, because this is particularly my thing that I do. I want to make sure this is clarified, and here's another example. Because if you learn VSA from other sources, you're not going to find this, unless they got it from me. This looks like initially a sign of weakness here, right? Higher prices attracting a lot of activity and a bearish reaction. Now, what happened over time? I mean, we're considering selling. Maybe we're saying this is such climactic volume, it wasn't sustained. As we come up in the area, particularly with the box, where we really need to see higher volume sustained activity, what did we get? Drop down to medium, okay, a lot less than initially, and then this one really is the deal breaker there. We moved up into new high ground. Now, where are those sellers? Where's that high volume, right? High prices attracting the sell activity on high volume. It's not there. So it continued. So again, you see that principle. This could have been, right, just mark this little resistance as it started here, moved up here, again, high volume, and seen a fake breakout pattern, like bearish reaction there, right? And at least that, fake breakout pattern, and those are always nice to see. That would have been more, and maybe the higher volumes there. But to break out, to see higher prices back on lower medium volume is not creating that fake breakout pattern there as it looked like it may have done, tells us it's not sustained selling and it's more likely to continue. So we'd still want to go with our trend until we see it properly end. And of course, going through this again, we don't see our trend properly ending here. We do see plenty of points where selling came in as far as profit taking or shorts that are now in drawdown, but we have not seen, again, today is it's over the weekend now. So going into next week, I'm seeing the high prices are bringing some higher volume, but we're not seeing a proper sustained high activity at high prices, climactic volume telling me to go short yet. So Monday, again, it may be slow. I tend to not trade Mondays, and by Tuesday I'll get an idea with more information by then about what may happen. The last point I want to make in this video is people are very often asking me, what do I think is going to happen at a time of day when, how can I put it, it doesn't matter, I don't care, because you need that new information. Okay, if the previous day had an uptrend, that higher prices showed some weakness coming in, but it wasn't really climactic high volume, so you're not really sure. What can you say about what you're going to do the next day? You're not going to trade off hours. You're not going to trade, at 2 GMT or 18 GMT. You want to stay between, again, 7, 8 GMT till 16 GMT. It tends to it shifts an hour with daylight savings, but London open to London close, basically, or middle of New York session is when you want to stop. So it doesn't really matter at that point. If I was trading London Open, I would wait for volume to warm up, start to pick up, and see the activity and see if it's confirming my background situation, which may be clear, or maybe it's not clear, and I need some more information. So we wait for that, proper activity to start coming in, and we can, lead it up to our decision and our entry. So, you don't have to go crazy off hours really thinking about it. It's, once the day is done, you need that new information for the next day. Even if it's a very bullish environment or very bear, I'm always using uptrends. Very bearish environment. You're looking to sell. You've seen a lot of weakness in the background. It's not looking like it's going to stop. Of course, you're not going to go into the next day and just sell randomly or sell at the wrong time of day. So you still want what could be a no demand signal, redistribution, right? You mark up your levels, support resistance, fibs, your pivots, and you see where the opportunities are going to come. Let it come to you. See how aggressive you want to be. See how good it looks. Take the information, judge the probability, right? So there's more stuff we're going to get into, but again, I just wanted to show first example of an entry, the no demand, no supply stuff. There's going to be range trading we're going to talk about. So we focused on trends here, and all more entries for trends. So this was again a recent trade and shows a lot of the tools and one of the more typical type of trades that I would take. So we'll end this one here.